Hi, I'm Max Keiser. This is the Keiser Report. You know, we've broken a lot of stories over the years. The hoax that is the fracking industry. We broke the global insurrection against banker occupation and a bunch of other ones that we were in the lead, covered it. Nobody else did. I think now we've got a tiger by the tail here. I think we're in the midst now of handing of the torch from the U.S. to China. The Thucydides trap is upon us. And it just gets more and more evidence coming in, Stacy.
Well, of course, we were also well ahead by a decade of everybody in terms of the JP Morgan rigging the precious metals markets. That happened. We also warned about Goldman Sachs and their crime spree. And of course, basically over the past few years, they've paid $5 billion in fines. They've paid another $2 billion this past week for their dodgy dealings over in Asia. And yet they didn't face any, jail time. Now, because of that crime wave that we've been focusing on and looking at, because we're markets, finance, and scandal, the Fed's balance sheet, they now own 22% of all marketable securities, which is up from 13% last September 2019. So the Fed's balance sheet is having to expand as the fraud expands, and the fraud can't shrink because you can't taper a Ponzi.
Right, exactly right. The fraud has been going exponential with Goldman Sachs, JP Morgan, and all the banks. And the Fed has been soaking up all the bad debt that, had they kept it on their balance sheet, these banks would have had to declare insolvency. And as a result, America is now losing out in the global geopolitical race to China. I think there's a direct connection. It's a direct connection. And now we're at a stage where, don't mention we also broke Bitcoin at $1 on this show. We're at that point now in history where the central bank cannot bail it out itself if it's the only boat in the water. In other words, America sprung a leak. It's sinking on the geopolitical stage to China, and to bail itself out, it's trying to shovel the water out of the boat, and then they put it back into the central bank, right? So they're doing this. That's how they're bailing themselves out. And of course, they're sinking.
Again, we've talked about this in previous episodes. It's just an inevitable thing. It's not like if it were France who were the empire right now, they would be doing the same thing. If it were Brazil, they would be doing the same thing. This is the inevitability. And what we're telling you is just prepare for such inevitabilities. This is what happens. This is why, the Thucydides trap is when a rising power always ends up in conflict with a shrinking power. And we hit that moment in, 2 years ago, when it was clear that Huawei, the Chinese telecoms giant, was way better and faster and better. Their product was cheaper and better than any product in the West in terms of 5G technology. So they were beating us in technology. So I want to look at one of the former biggest tech companies in the United States and how we chose. It's not like we're saying it's because that's a good guy or that's the bad guy. These are choices that were made. These are choices that apparently get made throughout history, because that's why empires always collapse the same way. They always make the same sort of choices. Over the last 20 years, IBM has bought back $136 billion of its stock. Its current market cap is $111 billion. And you can see from their bumps of when they bought back a huge amount in any one given year. And imagine if they had just allocated back in 2014 or 2012, $1 billion of it to their corporate treasury into Bitcoin. They would now be worth $300 billion, not $111 billion.
Right. This is why stock buybacks used to be illegal, because the company is just committing cannibalism on itself. And instead of putting money to work to develop markets, develop new products, research new products, they're just manipulating earnings so that the executives get big payouts. And they're extracting wealth from the company, extracting wealth from shareholders. There's a clear conflict of interest. And this is what a lot of companies are doing. Apple is doing it by the hundreds of billions of dollars, and other companies are buying back their own stock. MicroStrategy under Michael Saylor said, you know what, we're not going to buy back our own stock. We're going to put our cash on our balance sheet into Bitcoin. So he broke from the pack because he realized he doesn't want to be like IBM. He doesn't want to waste all of his cash on stock buybacks and see the stock drop. And this is unfortunately like bailing themselves out by buying their own stock. Again, they're trying to, it's a sinking boat, IBM. So they're bailing out their bad company by putting it back on the balance sheet, and it's not working.
And of course, that's kind of mirroring what the Fed is doing. It's essentially buying back the stock of America and hollowing out rather than investing in it. It's buying all the old bad debts of these same companies like IBM. It's putting it onto their balance sheet for no good. Like, it's not going towards any manufacturing in the United States. Remember, we're 10 months into this pandemic, and we're still unable
Think of
to
it
make
like
masks.
this. The Fed is like a giant pawn shop. You know, people take things to the pawn shop and they get cash for it. And they say, I'll come back and I'll buy it someday later. You know, and all these companies that have gone to the Fed to buy their stock from them to get cash, immediate cash, to give themselves a huge spending spree and credit spree and an executive bonus, by the time they go back to the pawn shop, the value has dropped considerably. And anytime you have all of your major corporations going to the pawn shop for cash, that's a bad signal. It's a bad sign.
Speaking of like going to the pawn shop and buying back your own stock and making no economic sense other than decline, this is an interesting tweet and then some data following it. China to US West Coast shipping is on fire. Container slots sell out, risking holiday shipageddon. No respite yet for trans-Pacific container shipping demand frenzy. So this is the shipping of goods from China to the West Coast of America. Remember, we had $1,200 stimulus checks. We had $600 extra a week on enhanced unemployment benefits. 75% of Americans were apparently making more money than they've ever had. Well, the ships are 100% full. The containers are 100% full. You can't get a container built. You can't pick up a ship from the spot market. The whole container shipping cycle is at absolutely full post, exclaimed Jeremy Nixon, CEO of Ocean Network Express, the world's 6th largest container line. So we're taking this money, sending it to China. They apparently are still willing to accept it in exchange for all the work they do to make these products and send it to us. But how do we get that to stay here? How do you get some of it to stay in the United States if the whole, the U.S. corporations like IBM are just hollowing out their company? And so you have to go to China to get all your goods.
Right. So China's experiencing a V-shaped recovery. COVID, like a meteor, hit planet Earth, boom. In some areas of the Earth, going to benefit because they were not hit by the meteor, and some got hit by the meteor, right? So China did not get hit by the COVID meteor. We can go into the details about their response, et cetera. I mean, I'm just stoically remarking on the facts of the case. I'm not making a judgment here. And as a result, they are shipping stuff to the West Coast in record amount. And of course, that trade imbalance is going to gap wide open.
Yeah.
And this is the beginning of the China century.
Yeah. I mean, all the data looks like that. Perhaps we could turn it around. Who knows? A lot of this was set in motion by Joe Biden, and the polls suggest he's going to win. So I don't know what he'll do to be able to stop it, especially, at this point in his career. But some market watchers thought volumes and rates would relent in the wake of the China Golden Week holiday in early October. It hasn't happened yet. The Trans-Pacific market is still at its peak. According to the Freightos Baltic Daily Index, spot rates from China to the West Coast were at 3,847 per 40-foot equivalent unit, FEU, on Friday of last week. They've hovered around the same stratospheric level since the last week of September, which is triple last year's rates. So again, it's hard to read all of this data because there's so much conflicting data, and that I think tends to happen as one order disintegrates and another is rising. It's hard to tell what's going on. I mean, tripling the rates of 2019 at the same time, you would think it's boom time in the economy. Or maybe it's just like we just have no manufacturing at all. So everything must be shipped here now versus last year.
Right. Well, one, historical data point to take a look at would be Japan in the mid-1980s, right? Japan was going to take over the world, and U.S. was going to fall back and be the second coming, the second-tier country. Japan was going to rule the world. Then, because of the internet was invented and proliferated, it uniquely satisfied the entrepreneurial instincts of the United States, and it gave us Amazon, Google, Apple, right? And then the US took off again. So that carried us for 10, 15, 20 years. But now, okay, you've got another Asian country. They're in a position to dominate. In the U.S., though, because you have political, no social cohesion, the social cohesion risk is too great, right? They've got too much infighting, too many battles going on. I don't think there's going to be an internet this time to save it.
Well, remember back in 2010, 2011, we were covering that social cohesion index that The Economist magazine had come up with, and they were talking about all the Arab Spring. And certainly, we've had here similar bizarre situations happening in the media space. We won't go too much into them. But here, so shipping, all the goods are coming this way, nothing's going that way. And domestically, here's another interesting story, kind of, feeds into all this buying back our own stock and the disintegration and what happens in the pandemic. Nobody's talking about it in the mainstream media, but commercial mortgage-backed securities traders say 90 to 120-day delinquencies on commercial real estate loans surging to $30 billion, up from $4 billion in June as pandemic lockdowns, new work rules crush prices. An estimated $40 billion in CMBS are in default. Hardest hit are bonds with exposures to hotels. There's a rent holiday all over the world, and these are going to have to disintegrate or go bankrupt at one point. Obviously, it's going to be transferred to the Fed's balance sheet, because I don't see them actually letting the holders of the, mostly in pension funds and things like that, passive investors holding these CMBS. I don't think they're going to let them go bust. So we're in that cycle that is a doom loop.
Right. Well, before the COVID hit, all countries around the world were trapped in a fiat game theory. Remember, China and the U.S. had a symbiotic relationship, and China had all the manufacturing capacity and the jobs, but the U.S. was the consumer and had great credit and could go into debt. And these two were in this joyous dance. But post-COVID now, it's a breakdown, and China is breaking away from the pack. And it's clearly establishing itself as not needing the U.S. anymore in terms of its ambitions for global economic dominance. And the U.S., with all of these bad debts now in the commercial real estate and residential real estate, that means that the central bank is going to have to expand their balance sheet by another, let's call it 15 to 20 trillion. And so that will at some point cause confidence in the U.S. dollar to evaporate. Then you have hyperinflation. Then you have a currency collapse. And then all that gold that China has and other countries have will be a huge factor.
Well, the IMF this week did point it out, of course, that they're looking for Bretton Woods too. So,
well, speaking of two, we got part two coming up right after this break. So don't go away. Welcome back to the Keiser Report. I'm Max Keiser. Time now to go to Andy Edstrom. He's a wealth manager, a hard money enthusiast, and he's the author of the blazingly brilliant book, Why Buy Bitcoin. Andy, welcome to the Keiser Report.
Thanks for having me, Max. It's great to be on with you.
All right. I had a chance to be on with you on a call on another podcast recently, and you're in the wealth management business. So you've been talking to people about Bitcoin for a while, many years. You've got a book out there. You're experiencing what people like Michael Saylor, who is just now experiencing. He's talking to other people about this asset class, and you're already pretty well versed in it. And let me ask you firstly about what's happening now in this market. Back in 2017, we saw the FOMO, fear of missing out, from the retail sector. Really, the mom and poppers out, the the fringe players, the internet crazy people, they drove it up to 20,000. We had a big correction, and now it looks like we're in the midst of what you might call corporate fear of missing out, corporate FOMO. Do you agree? Where's this going, Andy?
Yeah, I agree with you, Max. The corporate FOMO dynamic caught a lot of people by surprise, myself, included, to be honest. I mean, Michael Saylor came right over the top. As you mentioned, I did an analysis of his setup and how he first bought Bitcoin, then purchased shares to get people that weren't interested in owning Bitcoin out of his shareholder base, and then purchased more Bitcoin. And then, of course, we saw Jack and the crew at Square follow through. So, yeah, for sure, the clock is ticking. The starting gun has been fired. by Saylor, and you have to believe there will be others. And so, of course, as you've talked about it in the past, there's all these various sort of independent adoption waves. There's retail, which comes and goes in waves, which mints new hodlers. There's the hedge fund managers and the family offices, and there's the corporates, and eventually, we think we'll get the governments, and they're all on their own time scales. But I definitely think that the starting gun has been fired for the corporates, and I do expect that more companies are going to buy Bitcoin and put it on their balance sheet for sure.
Bitcoin is full of ironies. It's full of paradoxes, I guess, is the plural of paradox. And, in this case, going back to 2011, 2012, when Stacy and I were first getting into Bitcoin, people were really looking at it as for payments and thinking about it in terms of competing with PayPal. And as a matter of fact, BitPay was one of the very first companies out there, and there was going to be the PayPal of Bitcoin. But here we are in 2020, and we find out actually that corporations not thinking about this in terms of payments. They're thinking about it in terms of assets on the balance sheet as a way of a store of value. And that's like a complete twist to the narrative that nobody saw coming, really. And now we're in this period, as Michael Saylor of MicroStrategy, who put $425 million of the company's cash into Bitcoin recently, pointed out on another podcast, there are about 10,000 billionaires in the world, which include individuals and corporations. And they are all sitting on this, as he calls it, the melting ice cube, which is cash, in a world where every central bank in the world has said we're trying to inflate away the value of that cash by at least 2% a year. Of course, if you look at the numbers, it's a lot higher than that. And the market for this is staggering because it's a $210 billion asset versus literally $100 trillion available to try to find its way into Bitcoin. You're a wealth manager. Where does that take us?
Yeah. And this is where I try with my clients, Max, to just simplify the story. And right now, that's not difficult to do. You mentioned that earlier in its evolution or its adoption, Bitcoin was, thought to be useful for payments. And, in my book, I lay out several sort of upside cases or reasons to own Bitcoin. But far and away, the clear leader in the year 2020, when, as you say, all the banks, central banks are printing tons of money and inflation's coming, the clear narrative is digital gold. And it's that simple. And that's what I tell my clients. I mean, I talk about hard money assets, but gold is the leader there. Bitcoin will take share. By the way, I happen to think that gold as an investment is probably going to do well in the next few years. And that's good news for Bitcoin because, as you point out, as these corporate treasurers and these CEOs figure out that the purchasing power of the dollars and other currencies they have on their balance sheets is getting frittered away, is getting inflated away, they're going to want to own the hard money asset. And Bitcoin is the hardest money that I've ever seen.
Even a huge money management firm like Fidelity has come out with a statement saying, people should put up to 5% of their portfolio into Bitcoin. Okay, now they manage, they're up there in the bulge brackets. I think it's got to be $1 trillion or more, Fidelity. There's a few.
It's trillions. There's assets under management, and that's well over $1 trillion. And then there's the assets they custody, including retirement plans, right? 401k plans. That's something like 6 or 7 trillion, I want to say. It's huge numbers.
Paul Tudor Jones, of course. I'm asking you these money managing questions because we share that interest for sure, having myself a background in it. So when I see somebody like Paul Tudor Jones, who's, back from the 1980s, he was the golden child and called the 1987 crash, et cetera. He calls it the fastest horse in the race. He's a due diligent guy. The hedge funds come in. That's another multi-trillion-dollar market. So it's all coming in. In fact, the supply of Bitcoin coming off the miners on a daily basis, 100% is gobbled up by these huge buyers, and more than 100%. We're developing a situation where there could be a shortage of Bitcoin, in fact, for the retail crowd, because potentially the big players could buy it directly off miners for a premium. Do you think that's a possibility where the retail market for Bitcoin could dry up? You just can't find it. You just can't find it. For example, I can't buy a fractional piece of a Modigliani. They trade for $160 million a piece. I've got to pony up that money or not. I can't rip off a piece for a few million, can I? Is the retail
Yeah.
market for this going to dry up potentially?
Of course, it's that 4-year halving cycle, and it's just this mechanistic, brutally simple system whereby the issuance gets cut. And so far, every halving cycle, you get the supply cut, and then there's some period of some months where it kind of hangs out, and then at some point, that the demand starts to outweigh the supply, and you get the upward move. Now, as to your question about, is it too late for retail, basically? On the one hand, of course, this is the one asset in history, at least in modern history, that I'm aware of where retail got the first shot at it, right? Where institutional money was lagging. But, institutional money can take time, but eventually they figure it out. So yeah, I agree with you. There's going to be institutional buying pressure coming in. What that means for price, I'm obviously very bullish. And I do think that retail will continue in the next bull market. It'll just be the demand that was already there. There'll be additional incremental, in my opinion, when we hit an all-time high. The smart retail folks are stacking their sats right now, and they'll continue. And then yes, as the corporates and the other institutional players come in, that'll just be that much more buying pressure. So it's not too late. It's never too late with Bitcoin, right? I mean, as you pointed out, Max, you were telling people to buy it at $1. Were they too late at $10? Were they too late at $100? I don't think so.
All right, I'm going to read to you 9 words and get your reaction. Here we go. The IMF is calling for a new Bretton Woods.
And I tweeted about this. I think this is one of the most ridiculous statements I've ever heard in my life, and I'll tell you why. Bretton Woods, which occurred in basically the mid 1940s, after it was clear that the Allies, and specifically the United States, had won World War II, was a point in time where there had been a war, there had been a clear victor, and it was about constructing a new system in which the victor was dominant, and most of the world was falling in line, at least the developed world. Okay, that system is nothing like what we have today, right? Back then, the U.S. was 40%, close to half of world GDP. Europe was in ruins, essentially. That looks nothing like the world we have today. Oh, and then the last piece was the debt levels, right? Debt as a percent of GDP, both in the U.S. and globally, was actually far lower, even right after the war, right? We know that governments go into debt in order to conduct war, in order to finance war, and yet even after World War II, the debt to GDP ratios were significantly lower than they are today. So yeah, I think today's world does not look, hardly at all like what the Bretton Woods world did at that time. It might look, what could actually happen among countries? Could we see something like a Plaza Accord? Maybe, but my expectation is it's basically just financial anarchy, currency and monetary anarchy. Everybody's just going to keep printing, and I think this notion of a Bretton Woods accord, everyone comes to the table and implements some new monetary system, is a complete fantasy.
It's a horror show. When you watch a horror movie, the poor people are getting axed to death, or they're being fed into a wood chipper, and then some lucky folks find an escape hatch. So here you have the central banks. They realize they got to do a reset, like a Bretton Woods. It's too much debt. We got to go back to the table because we're all going to perish. And meanwhile, the smart money is saying, well, actually, we're just going to buy Bitcoin because it's completely outside of your control. It's unconfiscatable. It's the hardest money ever. It's better than gold. I mean, when you hear the Bank of England come out with a statement saying that we're going to come out with the bit gold because people don't want something backed by the government, right? They are so clueless. It's shocking. I guess that's to the point you were talking about earlier, that it's still very early on Bitcoin, considering it's at 11, 12, 12,500. If it gets pari passu with gold, you're talking 400,000 and above, right?
That's exactly right. It's among the clearest, investment theses that I've ever seen in my career. As you mentioned, I started my career on Wall Street. I worked for a hedge fund. I worked for a private equity fund, before I did wealth management. And yeah, the upside is so big. And all Bitcoin has to do in the next few years is take significant share from gold, as you described. I mean, it'll be great if, it takes share from fiat. It'll be great if people use it as the Swiss bank account in their pockets. It'll be great if there are all these new use cases that are built on top of it. That's all the sort of icing on the cake, and that's the longer term story. But for the next few years, yeah, taking market share from gold, that's all we need.
Okay, well, fantastic. Andy Edstrom, thanks for being on the Keiser Report.
Pleasure is mine, Max. Thanks for having me.
All right, and that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacy Herbert. I want to thank our guest, Andy Edstrom, who is the author of Why Buy Bitcoin? It's a darn good book. Catch us on social media if you can. Until next time, bye, y'all.